Hey, what's going on, guys? It's your boy Justin Sani here with you guys for another TradeStar video. And in today's video, we want to talk about market structure and the importance of market structure. There's a few key things we want to talk about. We want to talk about how and why it is so important to understand market structure. Number two is we want to talk about strong and weak highs and lows. Number three, we want to talk about shifts of momentum, changes of directions. And we want to talk about building out a map and putting it all together, right, with multi-time frame analysis. So let's go ahead and get started. Let's go ahead and hop on the charts and just start getting right on into it. The first thing is first, when it comes down to market structure, we have what we like to call market theory and then market reality, right? When it comes down to market theory, what I want you guys to understand about the theory of the market is there's a theory of how price is supposed to be delivered, aka an uptrend should look like this, a downtrend should look like this. That's the theory overall of how price should work in the sense of the market, right? In this example, we're going to talk about uptrends, downtrends, and change of trends. So we already have a good example of an uptrend drawn out. Let's just talk about these points. In an uptrend, one of your main objectives is going to be to understand what all of these key points are called. So what we do is we have a very nice example of a uptrending market here. So what we're going to do is we're going to go over the key points when it comes down to this trend, right? So the first thing is we have lows and then we have highs. And once price starts to have order flow, what ends up happening is we start creating higher lows and higher highs, higher lows and higher highs, right? There's a reason why these points are called higher highs, right? It's because this is a high point, but it's higher than this previous high point. This is a high point and it's higher than the previous high. Same thing with the higher lows. This is a low, but it's higher than this previous low. This is a low and it's higher than this previous low, right? So now that we kind of understand that, what we need to understand is the key points in structure. Structure in the market is going to be the one thing that teaches you how to understand not only where price is, but what's happening. So you need to understand what all these little points are called to, be consistent in the charts, right? And then here's an example of a downtrending market. In a downtrending market, we have lower highs and lower lows, correct? So the pattern goes from lower high to lower low, lower high to lower low, lower high to lower low. In theory, this is what a perfect downtrend is going to look like. But in reality, you're going to see trends that more so look something like this, right? And it may be hard to distinguish it, but after this video, our goal is going to be to teach you how to be able to spot these things and understand, right? Now, when it comes down to it, one of the biggest things that I see in the industry right now, people are having trouble with, is understanding targets, understanding how price ranges, understanding how price breaks through highs and lows, and having continuations, right? So what we need to talk about is weak highs and weak lows. So what is a weak high? What is a weak low? What is a strong high? What is a strong low? So the first thing you need to understand is how price is delivered, right? And what I mean by that is in an uptrending market, we have price moving like so, right? So a weak high and a strong low is the characteristics of an uptrend. In an uptrend, you're going to have very, very, very strong lows and you're going to have weak highs. So what is a weak high exactly? A weak high is simply just a high that price breaks through. These are going to be higher highs that get taken out, right? When it comes down to it, a weak high is not only a high that is going to be potentially taken out, but it's also a high that is a good upside target, right? Now, I had actually shot this video once and the audio was messed up. So I actually went through this very in depth with different examples and I'm going to be breaking them down for you guys here. But when it comes down to a weak high or a weak low, what I want you guys to understand is this, is in a uptrending market, the price is going to be moving something like this. It's going to be going up and pulling back and going higher and pulling back and then going higher. So in the sense of a weak high, weak highs are only found in an uptrending market. That's going to be one of the first notes that you want to take. A weak high is only found in an uptrending market. What a weak high really is this. It's the previous high after the last higher low, right? We know the significance of the last higher low after the highest high in the market, but what I want you guys to factor in is the previous high is always going to be a weak high. And what does that mean? In an uptrend, maybe we take a fib from the start to the finish, right? We take a fib. If the move started here, we take our fib from the low to the high. And what is the fib designed to do? It's designed to tell us how far price should potentially retrace to before we make that continuation move higher, right? Now, when it comes down to weak highs and weak lows and things like that, what I want you guys to understand is the way the market trends is in measured moves and measurements, right? I don't know if you guys have ever noticed this, but if you notice a trending market, 9 times out of 10, once the market has made its move, no matter how deep the retracement is, it usually doesn't go that much further up past the previous high. Example here. It doesn't matter if the move was 200 pips or 300 pips to the upside. It was a very deep retracement. Usually once price breaks through the high, it doesn't go that much further than that previous high. Hence why we use a negative 20 D extension level as a target. But what I want you guys to understand is you can actually use these weak highs. A weak high simply just means a high in an uptrend that is more than likely going to get broken. Every high in an uptrend is a weak high, and you should assume that that high, if the market continues uptrending, you should assume after that market breaks that high, it's either two things that are going to happen. It's either going to go a little bit further and start the next pullback retracement, or it may be a liquidity grab. So what I can recommend to you guys is this, is let's say you catch your sniper entry, whatever it is, somewhere here. Once price comes up to the previous high or that previous weak high, what I would recommend you guys doing is take off, partial out of your position. I like to partial out 70% of my position, and then I just let the remaining 30% ride. I move my stop losses to break even. It's a risk-free trade to me because I've already closed out 70+% of my position. In my mind, I'm no longer emotionally attached to this. I'm not glued to this screen. I can move on to the next setup and keep going and catching pips. Because as a trader, all you got to do is have short-term memory. If you win a trade, great. If you lose a trade, great. Figure out why you lost, keep it moving, have short-term memory, and keep moving to the next setup, right? In the sense of weak lows, a weak low is in a downtrend, very simple. A weak low is very, very easily put. It is simply the lower low in a downtrend that needs to be taken out. So in this example, here's our weak low. Price comes into a premium price. It puts in a strong high. Price moves down, puts in a new low, pulls back, creates a strong high, goes down again, breaks through the weak low. Weak lows are really good targets in a downtrend. The same way a weak high is a very good target in an uptrend. You only want to sell strong highs and you only want to buy strong lows, right? So I'll say it again. Buy strong lows, sell strong highs. Target weak highs, target weak lows, right? Now, when it comes down to it, the market may not ever give you a perfect setup that looks like this. Sometimes price is trending so healthily that all you see is this, right? But in regards to it, all you really need to understand is that targeting the weak low is something that you can always potentially, not necessarily guarantee, because nothing in this space is guaranteed, but it's somewhere where you can take majority of your position off, feel comfortable as you continue to ride the trade. Because in regards to this is very easy to look at, but it might be harder for you to line off all the key points, all the higher lows and higher highs and in the trend. And sometimes it's not going to be perfect. Sometimes price is not going to look perfect, like I said. But if you understand where you're at in price, then you can catch the overall picture, right? It's all about catching the overall trend in the picture, right? So we've covered strong highs and weak lows. Now I want to explain to you guys really the importance of market structure before we get into another topic which I had called external and internal structure, right? That's going to go into understanding multi-time frame analysis, right? Now, the reason why market structure is so important is because it is literally the foundation of your trading, right? FX is an auction market. And what that means is there's constantly bidders, there's constantly sellers, there's constantly an equilibrium where aggressive traders are meeting, but somebody has to be offering buys, someone has to be offering sells for price to be moving in whatever direction that it's moving in. So what you have to factor in is when it comes down to market structure in the pure essence, it has to be the foundation of how you approach the charts. If you feel lost, if you feel like you can't see, understanding structure is going to be one of the most important things, right? Now, understanding structure can be as simple as understanding higher highs and higher lows, but sometimes you might have crazy pullbacks. Sometimes you might have very complex pullbacks. Understanding the higher time frame is one of the biggest things you can do when it comes down to being able to trade lower time frames. I know all of you guys are on Instagram seeing these traders post 1 to 20, 1 to 50, 1 to 100, all this stuff, and it's 100% possible. But it doesn't mean that you need to rush the process. You want to trust the process, right? So when it comes down to it, trusting the process, when it comes down to the importance of market structure, is understanding a very in-depth aspect of a higher time frame to a lower time frame. What I like to do is I like to use Google Maps as an example. So in regards to it, what I want you guys to do is think about multi-time frame analysis, like looking at Google Maps, right? For instance, I'm going to pull up Google Maps right now. What I want you guys to do is think about looking at the higher time frame as like looking at the overall picture. Like right now, looking at the United States, think of that as like a monthly time frame, right? Still the same thing, but I'm seeing the overall big picture. Think about zooming in specifically to let's say Texas. Think of that as like the daily, weekly time frame, right? You know, I live in Dallas, Texas. So let's zoom in on Dallas. Now let's think of Dallas as like a 4-hour time frame, right? I can see all the noise. I can see everything a little bit more clearly. I can see Plano, Irving, Fort Worth, Arlington, Dallas, Garland, Plano. I can see everything, right? Now think about zooming into my specific neighborhood just a little bit more. I'm zooming in, and I zoom in. I can see my specific neighborhood just a little bit more, right? And when it comes down to it, now I'm seeing, you know, all the little streets, the restaurants, the shops, all of these amazing things, right? Now, what I want you guys to think of is when you're trading is looking at the overall higher time frame and the lower time frame as looking at the Google Maps. You're just zooming in to see the overall picture, right? And that's all multi-time frame analysis in essence truly is. Now, if we go back to Euro USD, what I want you guys to factor in is this drawing here. This drawing here is a great representation of what multi-time frame analysis looks like, right? Now, there's a lot of different things going on in this chart. There's continuations, there's shifts of momentum, there's higher time frame sentiment, there's lower time frame sentiment. So let's start on this. So I have a little key right here drawn for you guys, right? The black line, let's say it's a higher time frame. Let's say the blue line is a medium time frame. For the higher time frame to look like this, just like a trend line up or a trend up, for that to look like this, what we have to factor in is we have to factor in the lower time frame to look like this, right? You guys have to understand that there's so many different chops when it comes down to price. There's so much that goes on with it. So to clear it all out, what you guys want to take away from that is simply that you have to understand the overall higher time frame to understand where you're at in the trend, so you're able to take these trades on lower time frames, right? Now, what I'm breaking down here is very simple. You have to understand that price is going to make these series of higher highs and higher lows, higher highs and higher lows, and then there also is going to be change of characters. These orange arrows are change of characters where price breaks structure in the opposite direction. For a higher time frame to pull back, a lower time frame or a medium time frame needs to be changing directions. Same thing here. We put in a low on the higher time frame, well, we change directions on the medium time frame. Next pullback, there's your entry. Start riding the wave. Change of direction. Okay, next entry, sell down. All right, change of direction, next entry, pull back, buy, pull back, buy, so on and so forth, right? So you have to understand where you're at in price from a higher time frame perspective, just so you don't get caught in some BS, because it's very easy for you to be in a trade and you think price is downtrending because of the last change of character, and you get into a trade and price starts going down. You end up thinking, oh, it's going to keep going. But you know, maybe the medium time frame is showing you that, but the higher time frame is showing you a clear indication of a buy. So you have to understand the bigger picture to be able to come down and trade the smaller pictures, right? This is multi-time frame analysis into an essence, because what's going to happen is we have pro trend structure, pro trend, and then we have internal trend structure, right? Pro trend means that the overall directional bias. Internal trend means inside of the waves of the bigger trend, what is going on, right? Now, I had an example of this drawn out here. I'm going to go back over this in the simplest of ways. So think about this, guys. Think about us being right here at this point in the chart, right here, right? Let's say we're going to zoom in on this circle, and when we zoom in on this circle, what we end up seeing is this area right here, right? Whoops. Now, let's say price is in a very extreme uptrend on a higher time frame. Let's say this is the start of the trend, this is the finish. Let's say we throw our fib on so we can see our premium levels and our discount levels. And this is where we're at right now, right? So external pro trend structure means that the overall higher time frame is showing us bullish. Let's say we have some type of lower time frame break of structure, and then internally we're pulling back. Internal structure simply means when the higher time frame is pulling back inside point A and B from the start of the trend to the finish of that specific trend. This is what's happening on internally. Internally, what's happening is price is just pulling back into a deep discount level that ties up with a institutional level or order block like this blue box. And then what your job is going to be to do is to be very patient as a trader and wait, right? Let's say this is the 4 hour. Let's say maybe this is the 1 hour. Maybe this orange line is the 15-minute. Let's say we have a break of structure, change of character. On that next pullback, you have an entry. You catch that entry, and then maybe you start riding the waves up until the previous week high, right? It's a very, very good place to start targeting those highs. And by doing so, you're able to catch an opportunity that, hey, maybe it's a phenomenal risk to reward trade. This would be a 1 to 12 in this example. Obviously, this is an example, but we can show you hundreds of examples and hundreds of live trades that we've actually taken. We're catching a 1 to 5 or a 1 to 4, even a 1 to 10 plus is very realistic. But what do we have to do? We have to understand the higher time frame. Higher time frame comes first. Top down analysis. We got to understand the higher time frame to even think about looking at the lower time frame, because what will happen is you'll be trading in this range here, and then you'll be trading within this channel you think you see, right? And you're like, oh, price looks so good, it's bearish, I'm just gonna keep selling, sell. Okay, the next touch of my trend line, I'm selling. You sell here, stops you out, and then you're like, okay, I'm gonna sell here. You sell here, it goes a little bit in your favor, maybe you sell more, and then it gets you and it tricks you, right? And you don't want to trade what you see and not what you think you see. So many times traders are trading what they think they see and not in reality what they're actually seeing, right? So in regards to it, understanding multi-time frame analysis just means that there's trends inside of the trends. You got to know where you're at on the higher time frame so you don't get caught up on the lower time frame. Because mind you, I'll be honest with you, you'll get to a point where, hey, you're taking this higher time frame buy and you're taking this medium time frame buy, and then let's say you see price break structure and then you take a risky trade here and you take price down. If you're just targeting the previous week high or week low, a lot of the times you'll be able to take majority of your position, lock in the bag, and not get caught up in the wrong moves or get locked into having a winner turn into a loser, right? You never want to have winners turn into losers. Now, the last thing is just about building a map, right? what I want you guys to understand is about building a map is once you start understanding where price is going, you're going to be able to start building a map. Prime example, let's say we have a higher time frame. Higher time frame is looking like this, right? We have the high that puts in the low. And then let's say we have a very complex pullback. Price is doing this. It's looking very complex. You don't know what type of trend you're trading in. And then price comes back up into this. First things first is if you understand the higher time frame structure, you know that this is the high that put in this low, right? So in the sense of your structural range, you're trading from this high to this low. It doesn't matter what happens in between. The only thing that matters is either if this high gets taken out or if this low gets taken out, and then we have to factor in what's going on, right? Let's say the next thing we do is we throw our fib on from our market structure points and we get a very deep retracement, right? Let's say this retracement looks something like this, and maybe we have some divergence on this move, whatever. Let's say we have that first initial drop. Well, in the sense of it, we can say, hey, you know, this was looking like a lower high and then a lower low and then a lower high and then a lower low, and then price went up, so it must be bullish now. No, not at all, family. What you guys have to understand is it doesn't matter how deep or how far anything happens in between these 2 points. Until this lower low gets taken out or until the high gets taken out, we have to assume that price is bearish, right? Now, just for the drawings example, we're saying we're bearish. Now let's say price comes in, we have our first break of structure here, right? This is a change of character reversal break structure. This was the higher low that put in this higher high in the internal structure, right? This is our pro structure, this is our internal structure. The next pullback I get, I'm looking for an imbalance, I'm looking for a fair value gap, order block, whatever it is, fib, and then I'm going to start taking my trades and I'm going to start riding the waves, right? Now, where should I target? A good place to target if I'm trading this off of a very higher time frame is the week low. Because why? What could happen? There's so many times where price will just spike below this and then change directions. And there's so much times that price will go past this barely, and then it'll start making a retracement before it gets down. You want to just be able to sit in and lock something in. So taking off majority of your position at the week low is a good thing, because then you're not emotionally attached to it. You're not emotionally tied to the trade. You're not feeling stuck to the trade. You don't feel married to the trade. You've taken your majority of your position, you've locked in your bread, and you moved on to the next setup, right? So with that being said, guys, let's hop on to some actual charts and see what we can see in regards to some structure. All right, perfect. One thing that we've been seeing moving really nice as of late has been gold, right? Gold as of late, we can see it now. We're trading in a kind of a bearish channel, but what is happening in this bearish channel, right? We're making higher lows, lower highs, lower lows, lower highs, lower highs, lower highs, lower highs, lower lows, 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 right? What else is happening, family? Let's think about this together. Okay, breaking through a weak low, breaking through the weak lows, 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 and once again we've broke through the weak lows. So what does that mean? It means that, guys, you don't have to take trades and say, oh, I need to catch 200, 300, 400 pips on every setup. You can literally just catch for example, here's a supply zone. Here's a zone where we could potentially look to enter off of. There's an entry. Here's another zone that potentially look to get off of. There's an entry. Here's another zone you could trade off of. There's another entry. Here's another zone you could trade off of. There's an entry. Here's another order block to trade off of. There's an entry. Now, look at all these examples on gold just based off of us coming quickly and drawing the structure. Even if these points don't exist, taking the fib from high to low, understanding our fib videos, deep retracement to go lower, target those weak lows. What I want you guys to understand is there's so many opportunities once you find a market that's trending, whether it's a higher time frame, a lower time frame, medium time frame, it doesn't matter. As long as you understand the bigger picture and what's happening, you can take the entry, follow the trend, take majority of your position off of the weak low, wait for the next setup. Price reverses, there's an entry, weak low, take majority of your setup. Price reverses, gives you an entry, take your setup at the next week low. Price goes lower, puts in the low, pulls back, lower high, take your setup, take majority of your position off there. Same thing again. It keeps happening. It happens all day long. This is a very safe way for you to be able to understand market structure and then start adding more different things online. Right now, what I'm seeing is I'm seeing gold right here, put in a low, and this low actually went a little bit lower, and then we went through and we broke structure up, we pulled back, there's a mitigation there. I think gold is going to start going bullish now, right? But the reason why I think that is just because I'm zooming in and I'm understanding what's going on in the structure, right? In the structure on gold, gold has been very bearish, right? Gold has been extremely bearish. But what do we see? This is the lowest point, and what happens? This point right here. What did this do? This went just a little bit lower than the previous low. Liquidity grab. This was the lower high. This was the lower low. This was the lower high. This was the lowest low. Price breaks up above that lower high, aka change of direction, shift of momentum really quickly. Very simply put, in an uptrend, the market's going to be going like this. The market shifts direction when the previous higher low gets taken out. After that, you may experience a reversal, and then price will go lower. In a downtrend, the last lower high that puts in the lower low is where the shift of momentum occurs. If price breaks above this last lower high in a downtrend, you'll start seeing price start moving higher and going higher. And that's as simple it is to trade shift of momentum trades. Those are another trade that we really like, right? That's the safest and simplest way of putting it. But to break this down into more depth, right now we have technically broke structure to the upside. So what can we expect? If we see gold pop off through this range, if we pull back, I see a block here that's looking kind of juicy. Maybe we can react off this block, and then we can take price higher and keep riding the waves, right? Now, market structure might not be something that you understand and you're able to break down within a day, but it is something that, hey, once you start getting the hang of it, higher highs, higher lows, 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 highest high. Once you get to the point where you're able to identify these and clearly break, what's going to happen is you'll be able to see where price is shifting directions, understand that it's changing directions, catch these sweet entries for pullbacks, and then start riding all these waves down. You don't have to make it hard, just follow the waves, right? I hope you guys enjoyed this video over market structure. I really truly believe that market structure might be the key thing that you're lacking in your trading, that it's going to take you from inconsistent to consistent. And then it's something that if you really tone into it and master it, it could take you from not profitable to profitable, right? So we hope you enjoyed this market structure video. We enjoyed making it for you guys. And with that being said, we will see you guys in the next one. Peace. Don't forget, make sure you guys join the Discord. First link in the bio. We'll see you there. Take it easy.